Good morning and welcome to this webcast where we'll be discussing the tech challenges in an era of global workforces and remote working. Today I'm joined by Niels Reinau, who's a partner in our International Tax Services department and a leading tax specialist within PE risks. So today, if we move to the agenda, we will first be discussing our global workforces hopes and fears survey, which PwC did in 2024. This will be documenting the extent to which people are working remotely or hybridly, and cross-border. And of course, if you're working from home and that is cross-border, that of course poses a PE risk. Then Niels will be going through some of the rules just briefly, and then thirdly, we will be discussing what are the decisions that we are seeing the tax authorities are taking on PE home office. We'll be discussing international decisions. We'll also have a focus on the Danish decisions on PE, especially with a view to home office. And then finally, we will conclude by discussing what you can do in order to mitigate the risk of triggering a PE. So first, I'll be turning to the hopes and fears survey that was done in 2024. It is a survey of more than 55,000 employees in 50 countries. And one of the questions that was asked in that survey is, can your job be done remotely or from home? And actually, 48% answered yes to that question. Now, of those that can work remotely, 81% have done so. And that's just adding the full-time remote working with the hybrid working. So 81%, that's quite a lot. And then of those that have answered that they can work remotely, and then how many have done so cross-border? And that's actually 56% if you add the 51 and 5% together. So quite an amazing percentage of people have actually within the last 12 months been working remotely and actually cross-border. So that immediately kind of triggers a risk of triggering a PE. So if we go on to look at how is that kind of distributed over the different regions in the world, we can see actually, maybe quite surprisingly, that Asia Pacific and the Middle East is the high scorers here of the people that have been working cross-border and where the employer is aware. That is all you can see with the red markings. That's the highest score, is 81% in the Middle East. And maybe a little bit surprisingly also, 5% where the employer was not aware that an employee was working cross-border. Actually, maybe I was a little bit surprised that the EU was not more was higher in that distribution. So it's actually amongst the lowest percentages. If you take Western Europe and EU, we are around 39% that have been working cross-border, and again 5% did not tell their employer that they were working cross-border. If we then go on to see what are the industries where people are mostly working cross-border. Then my take of this is basically is a lot in the financial industry. So the asset and wealth management, the private equity, also the banking and capital markets. It's in the 60s percentages and also quite high again, where the employer was not told that you were working cross-border. And of course, the percentages I'm talking about here are taken from the ones that are working currently full-time remote or hybrid. So Niels, is that surprising to you that we're seeing the financial sector so high in this?
Not at all. Based on my experience with clients approaching us, most of the clients are actually within asset management, private equity, and banking. And I think this is industries where work can be done online via a link up and so on. So it ties very well with my practical experience here.
Yeah. If we then move on to looking into the seniority then basically 67% of senior executives said that their jobs could actually be done remotely or from home. And we can see that that falls with the grade. So the more junior you are, the less you yourself view that you can do your work from home. And that is maybe not surprising, because of course, if you just started the labor market, then you need training, you need to have on-the-job training and to sit with your colleagues in the physical workplace. But interesting that the senior executives view themselves to be able to work from home. And then the next question is, for the respondents whose jobs can be done remotely from home, how many have then actually done so? And 28% of the senior executives have been working from home, and 59% are working hybrid. So that means both from the office and from home. And then again, that is the same, but less remarked, pronounced distribution. It's a little bit more equal amongst the different layers here in the middle. And then finally, of the ones that have been working from home or hybrid within the last 12 months, how many have done so cross-border? And that is 81% that have done so. And that's, of course, pretty interesting, because as we will see in just a moment, senior executives that are working cross-border from their home office, that is actually the worst risk of them all for triggering a PE. But I think, Niels, you will come back to that and go more into detail on some of the decisions we have also seen in Denmark.
We'll come back to that, and especially the Danish practice on senior executives deviates from other kinds of employees. So this is a very important point.
Mm. So if we then look at the different generations in the labor market, then maybe not surprising at all, we can see that the younger the generations are, the more they believe, or the more they can work cross-border or have been working cross-border. So the generation Z, the youngest generation, 64% have been working cross-border of the cohort that have been working full-time, remote or hybrid. And 9% have not told their employer that they have done so. The millennials are a little bit less working remotely from abroad. And as we can see the pyramid, then of course, maybe not surprisingly, the oldest generations are not working so much remotely from abroad. So having looked at these survey questions, and I think the takeaway we can make here is that the remote working cross-border is very prevalent now. And in particular, the senior executives and the young people are working remotely cross-border. And then also, maybe surprisingly, and not an insignificant, a number of people are doing it without telling their employer that they are working remotely from abroad. So that, of course, poses some issues where maybe we'll return to that in the end, because what can you do as an employer if you are not really aware that your employees are working cross-border in order to avoid the PE? But we'll get back to that.
Yeah. Mm-hmm.
So moving on to now we've established the prevalence of working cross-border. Let's just go into what are the rules actually of triggering a PE. So I'll hand it over to you, Niels.
Yes, and let's start off with the basics. There are basically two kinds of PE. We are dealing with a fixed place of business PE, and we're dealing with dependent agent PEs. And what is relevant for this discussion is primarily the fixed place of business PE. So a PE is a fixed place of business through which a company carries out business, wholly or partly. So there are basically three conditions that must be fulfilled. There must be a place of business that the company has disposal over. The place of business must be fixed, and business must be carried out from this fixed place of business. So all three conditions must be present before a PE is deemed to exist. And as we note here, typically a place of business would be a branch or an office or a factory or workshop. Here we are focusing on home offices as a place of business. A PE can also exist due to the existence of a dependent agent, who is typically an individual who has authority to sign contracts on behalf of the company. And the definition of dependent agent PE has been developed here over the last years due to the OECD BEPS initiative. So the threshold for creating a dependent agent PE has been lowered. So now a specific authority to conclude contracts is no longer required. If the agent plays a principal role in closing a contract, that may also trigger a PE. So if we turn our heads to the issue of home offices, I think there are different key elements to consider here. The first one being, is a home office at the disposal of the company? And the OECD has, in their commentaries to the OECD Model Convention, addressed these issues. So there are different elements to consider. One is how often is the home office used for work for the company? Is it incidental or intermittent, or what we typically would say sporadic? So it's not planned, but it's something that happens more sporadically. Then we would not see a PE or a place of business being at the disposal. On the other hand, if the home office is used on a continuous basis and the company has required the employee to work from the home office and make a home office available, then we would see the home office at the disposal of the company. And that would make a PE possible. These follows from comment number 18. And in comment number 19, it appears that if you have a cross-frontier worker, so you have a worker working in one country, living in another country, and works from their home from time to time, and it's not a requirement from the company, then typically there would not be a disposal of a home office. So this is the OECD view, and in our experience, many countries apply these principles when we deal with home office PE situations. So a couple of questions arises here. What is intermittent, or what is sporadic? I think it's a question that depends highly on the specific facts of the specific case. But I think we can generally say that if the company and the employee has agreed that a certain amount of time, certain part of time should be spent at the home office, it would not be intermittent. So, for instance, if there's an agreement that 2 days a week the employee can work at home, we would not say that it's intermittent. Another question is, does it matter in terms of PE risk whether there are many home offices, many employees working from their own home office in a country or not? And I think also there we need to look at the specific case. In principle, it should not matter whether you have one employee working in a home office in a country, or you have 3 or you have 5. If they're all just working individually, and it's due to their individual needs and wishes. On the other hand, if you have a company that begins hiring people in a country to work from a home office, and this is an alternative to setting up an office, then I think it definitely matters that this is a strategy to have people present in a certain country without trying to trigger a PE. So I think we also need to look at the intent of the setup. Thirdly, seniority of the employee working at home, does that matter? It certainly does, and I think, Troels, you would comment on those.
Yeah, so basically we've tried to do this traffic light, very pedagogical figure here, where basically even if you have a fixed place or you otherwise trigger some of the points of being a dependent agent, then it will not trigger a PE if it is deemed that the activity is auxiliary or preparatory. And what does it mean to be auxiliary? Yeah, so what is not auxiliary is something that is identical to the general purpose of the whole enterprise. And I typically talk about it in a way where we say what is core and what is non-core to the company. And if we look at the furthest to the right, we have value-driving functions or core functions. And then you can see on the other axis, we have staff seniority. So it doesn't matter if you're junior or if you're a CEO, if you're doing core functions, then you cannot take this activity exemption of claiming it is an auxiliary function that you're doing. So it's all red to the right. Whereas if you are, for example, the HR director, even a part of the management team, then you could say HR is typically not, I would say always, not core. And therefore, you are in the top left corner, where I would argue that this is auxiliary with a certain likelihood at least. So that even if you're very senior, you're part of maybe a management team, but you are doing something that is not core to the business, then you can take this auxiliary exemption. And then we have all the ones in the middle, where it's a little bit more orange. And maybe the middle section is a little bit interesting, because you can say, whereas maybe that on the top we have the HR director, and to the right up in the other corner we have the CEO. Then maybe what about the CFO? So Niels, we have some decisions on that. How do you look at that?
Yeah, the CFO is particularly interesting here, because I think the CFO role differs greatly from company to company. In some cases, we've seen that the CFO has a more internal role. His role is more related to reporting and forecasting. There, we would see it as an internal function, and say we would argue that this is auxiliary. It's not very close to the income generation of the company. Whereas in other cases, the CFO has a wider role, where he's also responsible for strategy and maybe also have sales responsibilities, or is related to the sales organization. And there, in such cases, we would see him as probably part of the core business, because his activities might be closer to the income generation of the company. Other roles where we might have different answers could be procurement. If a head of procurement, we could argue generally could be auxiliary in many cases. However, if in a company the procurement is a very key element for the profitability, for instance, if you have a company who trades oil or other commodities traded on stock exchanges and so on, this can maybe a critical function, and it would not be auxiliary.
Yeah, and here maybe make sure that you have consistency with your, you say, value chain analysis in your master file, because if you're claiming that procurement is super key in your value chain, then it's probably the first place the tax authorities would look is to how does that square up with your maybe your assertion that this person who's the head of procurement is conducting an auxiliary function. So here I think consistency is key. Maybe, as Niels said, some industries, some companies, procurement super important. It's a key part of their value chain. Other sectors, maybe pharmaceuticals, for example, I would probably think that procurement for many of those companies is not super key in their value chain. So I think here is a facts and circumstances question of whether you can avail yourself of the auxiliary exemption or not.
And another thing to consider is this specific employee we're talking about here working in a specific country. If he has a bonus scheme and his salary is performance based on the sales or other metric, it could be an indication that his role is important and it's important for the income generation of the company. Yeah. And then so the existence of a bonus scheme could also impact the determination of whether it's auxiliary or not.
Yeah, maybe one thing we haven't mentioned, but everything that is sales related, directly generating sales, that's of course core and cannot be put under the auxiliary bracket.
And likewise, production of services, or if we're talking about a consulting company or a service company, the employees that provide the service, they are by definition core employees.
So, and I forgot to say that from the start, but you are welcome to ask questions, and I can see two of you have already done so. So we'll try to take them as we go along, and then we will take some of the questions in the end if we have time. So how often have you come across PE cases raised by the tax authorities in the post-COVID era due to limited number of employees working across borders?
Yeah, we have seen cases where the tax authorities have raised the issue. So it's not uncommon. I think what we see most is when the tax authorities raise the issue is construction work, installation work, because typically foreign companies are required to register their employees in the ROT register. So the tax authority has access to information, but we've also seen cases where companies have sales personnel or other personnel in Denmark, and they've seen, okay, we have an employee who's paying taxes here. There's an employer. Is there some connection between the company and Denmark, which could give rise to PE? So we've definitely seen that.
Yeah, I had a recent audit actually raised by the Danish tax authorities, and there we had two pretty senior people working out of Denmark for a UK company, and actually we were able to use the auxiliary exemption plus some other arguments. For example, that the company had not asked them to work out of Denmark, but it was for private reasons they were working out of Denmark. So in the end, the case was closed without adjustment, without any PE. But it's certainly not something that you should take lightly, because you could say if you are failing to register a PE, it also means something for individual taxation, and I think we'll come back to that later. So I think that's probably where the real kind of issue is when we're talking about this. It's not so much about corporate tax, because typically if you are avoiding a PE altogether that should have been there, and you don't have a subsidiary, and I'll show you that on the next slide, what I'm meaning about this. But so then there could be some corporate tax at stake as well. But I would say, for me, clearly individual taxation for the CEO or for the C-suite or for the senior decision makers that you are having sitting in working cross border, that might be the most important thing.
Yeah. One last point I would like to make on the auxiliary, not auxiliary, is something as basic as the title of the employee who's working in Denmark, let's say that, for a foreign company, may also trigger the interest of the tax authorities. And as a peculiar case, a couple of years ago, I had a case with a well-known banana brand who were contacted by the tax authorities because they could see that there was a key account manager working for this brand in Denmark. And they thought, okay, this sounds like a sales employee. Why don't you have a PE? And when we talked to the company and found out what this person actually did, it was clear that it was an auxiliary activity, because what the person really did was to make sure that the products were displayed appropriately in the supermarkets. So he was visiting supermarkets and checked that the bananas were presented nicely. So that was clearly not a core business activity in this specific case. But it goes to show that the Danish tax authorities may have interest in these situations where it seems that, okay, there could be a PE.
So you could say, I mean, yes, the title might seem a little kind of, maybe it's over exaggerating a little bit, you could say the value creation or the seniority or whatever. I mean, we had another case we discussed about an area sales manager, and where Skat was kind of saying, it pointed towards that he had a managing position. But I mean, but again, it's all about the substance. So if you ever kind of inquired about these things, then of course the facts are the key here. So if you can then during an audit show exactly what the employee is doing, then I guess the title matters less. But of course, if you are talking about a CEO, then there's nothing to do. That's clear. Exactly. That's clear. We have another question. What is your initial take on sales trainers? So trainers for the sales force, is that an auxiliary function? Or what is your initial?
I think it depends. But training, I would say in general, I would view as auxiliary. Of course, training is an enabling function. As if we look at our illustration here, training is enabling, but it is probably closely related to sales. So here we would be very careful to look at the exact job description of such a trainer. Sometimes if it's on the job training and he is the trainer is participating in sales to teach others, it could be bordering a core business. If it's more distant from the sales activity itself, I would say that it's auxiliary. I think it's difficult to be very specific here.
Yeah. So moving on to the next agenda point. So what are we seeing from tax authorities? So if we kind of look at first kind of what's the kind of universe here. So we have different scenarios. We have the scenario one where employees are working from home outside country A, so cross border, where their employer is based, and this does not constitute a PE. So this could, for example, be because the function, as we just touched upon, is an auxiliary function. It's a non-core function. Then, of course, we have scenario two, where the opposite is the case, where we might have a CEO working from abroad. We have a case that Niels will go through in a second on this. So that triggers a PE. And then we have scenario three, which is kind of the solution that I sometimes recommend companies. If they do have a subsidiary in a country, and they, for various reasons, need to employ a senior decision maker in that country because he wants to live with his family, he doesn't want to move to Denmark, and he doesn't want to be employed in Denmark because maybe of taxation, then typically what we see is that some companies actually employ, you could say, group functions in a local LRD, for example, to be very concrete. So you could say functions that are not really belonging naturally in that local subsidiary. So that's the third scenario. And then we have the fourth scenario, and that's actually one of the third question we received here, is, you're using independent agents or contractors to start up a market maybe as the sales force, for example, and then you're using basically an employer of record, a payrolling agency, as the kind of middleman. So that's, for example, in this case in scenario 4, could be an external company. We know there's a whole industry of that. It could also be the local opco that is working as or functioning as the employer of record. But if we take the more kind of prevalent scenario that also is behind the question, is that can we, with the change of the rules, with the MLI, the update with the MLI, can we still rely on the independent agent rule if you're only working for one employer like the HQ?
Yeah, and in general, the answer is no, because in tax law we apply a substance over form approach. So if you have, even though it's not formally your own employee, but it's an independent contractor or it's an employee that is hired by a payrolling entity, if he only works for your company and receives instructions from your company, then we look at him as de facto being an employee, and we have to determine PE risk on that basis.
Yeah. Good. But moving on, I think, Niels, did you want to say some more?
Yeah, I think maybe if we go back, I think the last bullet in the red box here, if we have an employee being seconded from one country to another, so under the secondment he's working for a company in another country, then secondment in general does not trigger PE risk if the seconded employee works for the new company. However, if the seconded employee continues to carry out tasks for their home country as well, then we have a PE risk as in any other case. Mm. So secondment can be a good solution in many cases, but we cannot use secondment to circumvent a PE situation if the employee is still working for the HQ.
Yeah, and maybe touching upon that, Niels, I think it's probably also pretty prevalent that in scenario 3, where you're having you could say a group function working from a subsidiary, that person actually has a dual role. So it both works for the local subsidiary, but maybe also has a group responsibility or regional responsibility. So I think we have these mixed, you could say, functions. We see that quite a lot as well.
Yes, definitely. And those mixed scenarios are often complex to work with, and I think as Troels, you mentioned that we can go a long way by ensuring that the transfer pricing setup concerning these employees is correct and on arm's length, so we make sure that the income related to the activity is taxed in the appropriate country.
Yeah, and maybe I'll come back to that, but maybe on that note, I think it is definitely something that a lot of countries accept. Very few, I mean, there's especially the bigger countries, they don't really want to stipulate like a dual presence. So where you both have a subsidiary and then you have a PE, which would then be a zero PE. So allocating zero income to that PE. If you have already allocated enough, so arm's length remuneration under Article 9 to the local OPCO, then there would be no extra allocation that you need to do to the PE. And having said that, then some of the tax authorities will say, okay, fine, then they're not looking at that. And so it will only be a discussion about what is the right transfer pricing arrangement. Is it a cost plus 10? Is it a cost plus 15? Or is it indeed something more than a cost plus? But I'll come back to that later. Yeah. So moving on to what are we seeing actually from abroad in terms of the home offices?
Yes, we included this slide just to show that we see different trends in different countries, and it's not easy to, or we cannot say that there is one way of looking at this. There are very different takes on this. So we just made some examples here, and we can briefly go through them. In Australia, we saw a case from last year with a company that applied a work from home plan for all of their employees, where this specific company allowed employees only to go to the office a few days a month and otherwise work at home. And in this case here, the Australian tax authorities accepted that there would be no Australian PE due to the CEO working primarily from his home office in Australia, even remotely, even though he worked for a foreign company. In this case, it was an important fact that there were no direct activity with customers in Australia. So there was no link to Australia, and there was no real business interest in the company having the CEO working in Australia. And I think when we look at the Danish cases in a bit, it's very clear that this is a different approach than is applied in Danish practice. We have a Polish case from 22, where a company had an employee, a foreign company had an employee in Poland working continuously from a home office. The employee was doing some technical back office work. I think it was IT support. And the Polish tax authorities ruled that this could constitute a PE, and the home office was at disposal, but the nature of the work here was auxiliary. And I think that's obvious that technical back office work would be auxiliary. So maybe that's not so surprising. Then we have an interesting item from the Netherlands and Belgium. Sorry. Of course, these are neighboring countries, and we would expect that there's a lot of people working in one country, living in the other country. And due to this, the two countries has agreed on a protocol to the tax treaty. And so the rules on home office have become more easy to understand and also to handle. Under this, basically, I'll not go through all the details, but basically under this protocol, either, of course, if the work is preparatory or auxiliary, there's no PE and there's no disposal of a home office. Secondly, if the work of the home office is less than 50% of the total work, so the employee spends less than 50% of his working time at home, then there's no disposal of a PE. If the working time at the home office is more than 50%, but the company has not required him to work from home, generally there would still be no disposal of a home office. And it's only in the event that more than 50% of the work time is spent at the home office and the company has required the employee to work from the home office, then there will be disposal of a PE. And I think this is a very clear guideline, which is something that the companies can really apply in planning their work force.
I guess Netherlands, Belgium would then be one end of the extreme, I guess, and Denmark wouldn't be in the other end of the extreme, and you'll come to that later.
We'll come back to that. We also included a Swedish case, and it's clear that in Sweden there has been some development in practice as well, and it appears now that in Sweden a main focus has the foreign company a commercial benefit from having the employee working in Sweden. And if that's not the case, the risk of creating a PE appears to be low. So I think that's also deviating from the Danish take on this as well. So let's give the slide to the next.
Yeah.
So yes, I think we went through the conditions for a fixed place of business. Under the COVID-19 crisis, the tax authorities issued guidelines on different issues to address specific problems that were created by the travel restrictions under the COVID. So people having a foreign employer could not travel to work for their foreign employer, had to stay at home, which could create PE risk, of course. It could could create risk of personal tax liability. It could create risk of effective place of business or effective place of management of a company if these employees were CEOs and so on. And with respect to PE and home office, the tax authorities looked at previous practice and developed some guidelines which has been applied ever since. So even though this was related to COVID-19, we still see these guidelines being applied in cases which are published on PE. So we've included these four considerations here that must be made in order to determine whether a home office is at the disposal of a company. And the first one, does the company or does the employer have another permanent workplace available where the work is usually performed? So the question is here, has the employee an office or an office space available at the company's headquarters, at the company location? That is, if so, this is an indicator that there should not be a disposal or a home office. Of course, this is not decisive in itself. So the other considerations must also be made. Second one is there an agreement between the company and the employee to perform part of his work from the home? So is it something which the parties have agreed upon, either directly in a contract or implicitly by allowing it, or maybe saying, okay, it makes sense that you work from home. Third one is, and I think the third one and the fourth one are probably the most important, the work from the home office, does that occur randomly or sporadically? Or is it something that has been planned between the employer and the employee? In the latter case, so we'll see some cases in a minute. If it's been planned that there's been fixed days, 2 days at home, 3 days at the office, then it's not randomly or sporadically. And lastly, is there any business advantage for the company to have the employee working from a home office in Denmark? I think, as mentioned, I think especially the two last considerations have been the ones that are decisive for the PE question. And then we've included some judgments here or some rulings. There are many rulings, and we sort of taking 3 examples which show some different outcomes. The ones I show here relates to CEO or senior executives, and the first one. You had a foreign consulting company with a CEO who was based in Denmark. He has his family in Denmark, and he agreed with the company that he would work 40% of his time in Denmark. And he received approval from this, and it was determined that, firstly, this work pattern was not sporadic or random. Secondly, it was determined that the CEO in this specific case here had a decisive influence over daily management, and he was a very significant person for the company. So based on this, the tax agency ruled that due to his decisive influence and his importance, the company had an interest in being in Denmark, in having the CEO being in Denmark, which maybe seems a little bit strange that even though the CEO worked in Denmark due to family reasons and his personal reasons, because of his importance to the company had a specific reason to be in Denmark. So the tax authorities ruled that all of the 4 considerations we discussed just before pointed towards the fact that there would be a disposal of a home office, and since it's a CEO, his activities were by nature core business activities that would create a PE. And we have there are other rulings that come to the same result. For instance, the one I mentioned here in the slide. The second example is a CFO who was also a member of the executive board. He would work also 2 days in Denmark. Again, this was not random or sporadic, but in this case, the CFO role was deemed to be a more internal role, as we discussed earlier. The CFO was more of an internal. So in this case, there would be no business advantage in having a CFO working in Denmark, and I think it would also probably be deemed an auxiliary activity in this case. The third one, and I think that's probably interesting compared to the first one on the left we discussed before. Here we had similar facts as in the first case, but here the facts that were presented to the tax agency was that the work in Denmark at the home office would only occur randomly and sporadically. And I think it's difficult to read out of the ruling how many days or the fraction of time spent in Denmark compared to the fraction of time spent at the head office abroad. So I think probably the company here was a bit lucky that they could have it accepted as random or sporadic. I think towards when we look at the case, I think it's difficult to see why we have a different outcome.
Yeah, so I think maybe that decision is not worth so much for the company, because if the reality is that he does work the same pattern as the first case with the 40% or even 20 or 10, but if it can be planned or is planned, then basically it cannot come under the exemption of randomly and sporadically. So, but it was a binding ruling, and Skat is of course basing their decision on, and the Skatterådet in this case, basing their decision on the facts that they have been told or informed about.
I think let's move on to the next slide as time progresses. So here we have some cases on people with non-managerial authority. So I think I'll go through them quickly. The first one, the case from 2020, the employee was working from home in Denmark for a period of 6 months. It was deemed to be a core business for the German employer because his work related to building a business in Denmark, pre-negotiating contracts, building a website, preparing a market entry in Denmark. So the tax authorities deemed this to be a core business, and they also deemed the company to have an interest in having him work in Denmark. So I think that's probably clear. What's interesting here is that 6 months was deemed to be sufficient for the activity to be a permanent nature. And I think 6 months, we generally see the 6 months as the lower threshold for deeming a PE. The second one here, and I think the reference is not correct. It should be not be 2021 for it should be 2021 458. Here we had an employee working as head of strategy and transformation, would work 1 day a week in Denmark for 18 months. In this case, it was clear that the company did not have any interest in the Danish market. They didn't have any Danish clients or customers, and the intention was not for the employee to work on the Danish market. So here, the taxpayer was successful in reaching the conclusion that the company did not have any business interest in having him work in Denmark. The last one, it's more or less similar to the first one, I think. The employee would work in Denmark, and he would establish a sales channel and develop the Scandinavian market. And even though most of his work related to the other Scandinavian countries, and he would travel a lot to the Scandinavian countries, I think basically he would only spend 10 or 15% of his time in Denmark. The tax authorities ruled that he did have a central function in developing the Scandinavian market, and he had a core business activity. So he would create a PE.
Yes.
So, and here we PwC did a survey on home risk of PE in home office situations. And I just picked out a few examples from this. I don't want to go into it in detail, but it shows that in terms of duration of the activities, different countries use different thresholds. So we have probably the most aggressive country here is Norway, where a PE is possible from day one. And we have Belgium, which says that a PE could be possible for a duration of 30 days or more, to other countries where you apply the 6 months thresholds that we usually see in OECD situations. So this is just a message that if you have employees working from home in other countries, you might have situations where other countries will have a very low threshold.
Yeah. So, what might you do in response to the more prevalent cross-border working, and maybe also the fact that that you're not always informed, the tax function is not always informed about what the workers, when they are working from abroad and cross-border. So one of the methods that one of the you would say ways of trying to limit the risk of a PE, and one that's quite frequently used, is basically to employ the workers, the group function, the people. If you have a subsidiary in a local country, for example, an LRD, and you have a senior decision maker, or you have somebody who has enough bargaining power to say, I don't want to go to Denmark, I want to work from my home country, then what we often see is that the person is having an employment contract with the local entity. So that's the formal employer. Now, does that actually does that completely mitigate the risk? No. It does not eliminate the PE risk, but as I said before, most tax authorities don't want to go there when it comes to the corporate income tax, because stipulating a PE, as long as we have remunerated the group function in a correct arm's length way, and that could be a cost plus 10, 15, then typically tax authorities are okay. So the only difference there would be in trying to stipulate a PE in that situation is if there is a delta between what the AOA, so the Article 7 attribution of profits to permanent establishment guidance says, where we have to look at the significant people function, and that draws the risk to them. So only in the case where we have a difference between, because of course under Article 9 we can contractually allocate the risk. At least we could do that before 2017. Now we have delineation as well, which comes a little close actually to the AOA. So you can say the two concepts, Article 9, Article 7, are converging. But I would still say that if what would you do as a tax authority if you say, okay, we think that this senior decision maker is triggering a PE and we need to allocate some income to him. So how would you do that, except for if it should be a cost plus 10 or 15? Some tax authorities, like the HMRC in the UK, they sometimes claim that if there is enough senior decision makers working out of an LRD, for example, then they want to see a profit split, for example. Now, that doesn't make any sense to claim a global profit split if you are having a few people sitting, even if they're senior decision makers. I believe that the HMRC is primarily saying this in order to gain a better outcome for the routine remuneration. So basically, they're bumping up the return they're getting for the LRD function by saying, hey, we have these people that are sitting, and they are certainly not just routine activities. So what we're seeing is that tax authorities are trying to solve this within Article 9 without going into Article 7 and PE attributions. But if we are to be completely theoretically correct, then, as is also given here on the slide, Article 15 is saying that if the substance is that you are effectively working for the HQ, then you might have a formal contract with the local OPCO. But actually, as a tax authority, you would be able to see through that and basically recharacterize or put that contract aside, and in reality say your economic employer is actually the HQ. And while that might not matter for the reasons I just gave from a corporate tax perspective, you are not allocating more corporate tax to that jurisdiction, no matter if you have an LRD plus a PE or if you are remunerating the group function together in Article 9 together with the LRD. While it does matter for corporate tax reasons, it does matter for individual income taxation purposes. And here, if the tax authority goes in and puts aside the formal contract and say, no, your economic employer is the HQ, then if the C-suite person, for example, if it's the CFO or if it's the head of supply or head of procurement that is working as a displaced worker out of the LRD, if he's traveling back, which he would always do for a management meeting, then he's taxable on day one when he's going back to Denmark. And that is super important because, of course, there will be no double taxation. You will get a credit in the LRD country for the personal income tax you pay in Denmark. But if you are not in compliance with any of this, there could be penalties, and the company will be the one that has to pay this. And I also believe that since we're talking about typically C-suite and senior decision makers in your organization, you're probably also not going to be popular in the tax function if you have not told them about this. So super important to know the scenario on the right. Yes, we can definitely mitigate the risk from a corporate tax, from a TP and a PE perspective, but personal income taxation is another thing.
Yeah, definitely agree. And we have projects for clients dealing with these exact issues where we have to find out how to make the most optimal structure that does not create any problems, both in terms of PE and also in terms of personal taxation.
Yeah. So moving on to maybe the last, what are the suggested actions for you? So I think, talking to the HR and the legal departments to try to develop joint policies and understand what the policies are. So what are the kind of company policy for hybrid work, for maybe different seniorities have different, possibilities of working from cross-border, trying to be, in control, understand what's going on in your company. How much are people working from abroad? Which categories of people, which functions are working from abroad? And then establishing policies maybe that will mitigate the risk of triggering a PE. So I think, Niels, you have some experience with devising these policies. What would that kind of consist of typically?
One thing could be to consider, are we allowing people to work from home at a more planned fashion? So 1 day, 2 days a week, as we've seen. If we do so, it cannot be regarded as a random or sporadic setup. Or are we only going to allow people to work from home at more random occasions? That could be a risk mitigation. Secondly, are we setting any threshold for how many days per year, for instance, an employee must be can work at home? Are we setting any restrictions as to what kind of activities can be carried out by the employee working from home? For instance, it could be relevant to ensure that they do not sign contracts related to sales. For instance, they do not, if it's a senior employee, they do not make any formal management decisions and so on. That could be items to address in a company policy for allowing people to work from home in a different country.
So before leaving you, I'll take just another minute. Is the OECD is basically currently working on this as we speak. So there's a meeting this month where and the first item on the agenda is trying to give more clear guidance and clarifications in the commentary to the OECD model on home offices. So exactly what we have talked about today. So I think what the OECD wants to avoid is to have a very heterogeneous kind of interpretation that we have seen. I mean, the list you just showed before, Niels, shows that a lot of countries have different kind of time limits and so forth. So there's a lot of heterogeneity. You have Denmark in one end of the spectrum where it's very easy. It's almost impossible not to have a home office. So you have to rely on the auxiliary function that you're doing, and or you have to be kind of sporadic working out of your home office. So you have ends of the spectrum, and the OECD is trying to give further guidance and clarification to the commentary on this. Our expectation is that the big countries in the OECD wants to avoid these micro PEs because it's a lot of compliance. There's a lot of it doesn't really lead to any tax revenue. So I think our expectation is that some borders would be put down so that, for example, Denmark cannot stipulate home offices as frequently as we have seen in the last couple of years.
Yeah, I think that's my expectation as well. But let's see what comes out of the OECD here, hopefully soon.
So thank you very much. I'm sorry we went 2 minutes past 10, but hopefully this was interesting for you. And stay tuned. We will, if you have any questions, we will follow up with you. Thank you very much.
Thank you.